Taxation of your retirement accounts is always a big concern. And last week, we looked at how those assets are taxed while you're living. Today is part 2, and we will look at the tax implications of those 401ks and IRAs when you die. I'm joined by Vince McManus from Parkersburg, and this is Wealth Wednesday. Hello, welcome back. This is part 2 of our series about taxing retirement accounts. If you'd like to see part 1, you can check that out on our website or our YouTube channel. Our website is cfswv.com. Our YouTube channel is at Commonwealth Financial. Today, I'm joined by Vince McManus. He's a financial advisor in our Parkersburg office. And last week, on part 1, we looked at Bill and Janet. They retired with $750,000 in a 401k, and they wanted to know how that was going to be taxed. So they also have a daughter. Her name is Barbie, and she is married to Ken. They live in California, Malibu, exactly, where she's a successful real estate agent, and Ken is a software engineer of a tech firm. Now, everything that we're showing you here today, I want to preface this by saying this has been compiled in our financial planning software to model these distributions and growth and things. And they're just for illustrative purposes only. These aren't real people. So we're going to start out by saying that Bill dies at age 71, and we want to know what happens to his IRA when he dies. And you can see from this chart that his account is worth about $233,000. Janet's account is still about $464,000 or so. This is going to transfer to Janet as if she's been properly named as the beneficiary on this account. She's not going to incur any taxes on this. So she's going to basically combine this into her IRA. Now, a couple of things that you have to consider. Most of the time, the spouse is going to transfer this to their own IRA, and they have to observe the required minimum distribution rules just as if it was their own. Now, there are a few exceptions, and over the last 25 years or so, we've seen this happen just a couple of times, but sometimes a spouse will leave it as an inherited IRA so they can take money out penalty free. And about the only time that we've ever seen this is when that spouse was younger than 59 and a half. But the key thing here is when that transfer happens to a spouse, there's no tax that's going to be due until the surviving spouse has to take the required minimum distributions. Vince, things are going to get a little more complex when Janet passes away and the assets transfer to her daughter, Barbie.
Sure. For illustration purposes, again, we'll just assume that Janet dies at age 82. So the chart that's on your screen shows the remaining account values in Janet's IRA. So at that time, when she's 82, her assets we're assuming were worth about $597,000. But so what happens when that goes to her daughter? Well, again, I always am fond of saying this to people in meetings is you have a silent partner in your own personal LLC, and its name is Uncle Sam. So the IRS, Uncle Sam is always going to be a partner or beneficiary of the IRA account. Again, there was a tax benefit when those were put in, a tax deduction was available. So that when it comes out, there's going to correspondingly be something owed to Uncle Sam. Usually the tax code isn't set up to give away things for free, unfortunately. So what we're looking at here is the orange box shows the total taxes and expenses that will eventually be due on this transaction, assuming that the daughter is in the 24% federal estate tax bracket, Barbie, and a 6% state income tax bracket, which we'll say she moved to West Virginia to save on taxes instead of staying in California. But as you can see, if it was assumed just a lump sum taken out, Uncle Sam's share ultimately would have been about $170,000 of that $597,000. So that just gives us a starting point or potential idea of like, hey, what is Uncle Sam's share? And as you can see, that you have to make some assumptions there because it's based off of the specific beneficiary tax rate. So that's something that we usually try to find out or have some idea of while we're working with a family to know maybe what their children do or things like that. So we can kind of help forecast this a little bit more accurately.
Yeah, and one of the things that I always see when I'm reading articles and stuff about this topic is the potential tax bomb that exists in these 401k plans. And a lot of that is trying to discourage people from using the pre-tax money. The downside is that a lot of people that are retiring now, that's all they had available to them. And it's just accumulated as to what it has been. The Roth 401ks weren't available until just recently. So a lot of people have this pre-tax money, and you shouldn't necessarily stop using the 401k. It's still a great way to accumulate funds for your retirement. And anytime you can do something easily, you should do it. Now, the Roth 401k is a better tool for multi-generational planning and for longer term tax planning in most cases, but it's not necessarily a uniform across the board rule. Vince, next week, we're going to focus on some things that Bill and Janet can do to help reduce the overall impact of taxes, including a more detailed look at those Roth conversions. But by and large, when you're talking to clients about this type of situation, how are you approaching the multi-generational tax conversation?
Yeah, I mean, the first thing I'm usually doing, again, and anybody that listens to these Wealth Wednesdays or hears me talk in a meeting, it's referencing your plan. That's always going to be the guiding light, because that's the thing that is specific to an individual family or person, and that's how we really get into the weeds and get into the details of what makes the most sense in you or your family's particular situation. Again, for some people, it may make sense to do all Roth. For others, it may make sense to do none. Really, the devil is truly in the details for all of that stuff, and it really gets down to the idea that there really is a lot of there's a lot of science and numbers and hard stuff in this industry, but really this gets down to the art of it. And I think this is where a lot of the value add is to people, even someone who understands investments and maybe even likes it, where talking to us can really help them kind of broaden their horizons and maybe think of some ideas of how they want to structure their money for their life and potentially their children's life or their children's life. It all depends on, what someone's goals and wishes are. And then we try to figure out a way to kind of get into there. So it's just important that we understand, how these benefits are going to be taxed when they move from one generation to the next, because the numbers can, as you can see, Uncle Sam's share can differ drastically based on how we're structuring that. And then again, there's always the idea that the rules can change in the future. They did change a few years ago in terms of like inherited IRAs and the time frame that people had to take those out. Typically, the IRS and Congress doesn't like to do that. But again, if you think of the government as a poorly run business, they constantly have cash flow issues. So they have to change rules sometimes midstream. That doesn't necessarily seem fair to us, but it does happen from time to time. So again, thinking from multi-generation perspective is very useful, but we always want to make sure we temper it and bring people back to reality, so they have an understanding and lead them where we want them to be, and then where they want to be, to where they make the decision that is best for their families.
Exactly. And on next week's show, we're going to focus on the idea of Roth conversions and how that may help Bill and Janet and their daughter as they move forward, just to see what the overall impact of that is. So if you'd like to catch that episode, please be sure to like and subscribe today. If you have questions about how your retirement accounts are going to be taxed, you want to reach out to one of our financial planners like Vince or myself, check us out on the web, cfswv.com. We'd be happy to answer any questions that you might have. Thanks for watching. Have a great week.